Everyone to the webinar on the impact of Budget 2025 and the recent GST amendments on the retail industry. The key theme for the webinar of the day is how can the retail companies gear up to comply with the Budget 2025 changes and the recent GST amendments? We welcome our speakers for the day. Mr. Parekh, who's a senior partner and a tax leader in the consumer and retail sector at EY. He handles international tax and transfer pricing and is also a leader for consumer products and the retail sector tax in EY India. He's a qualified chartered accountant with over 23 years of experience. Welcome, Mr. Paresh. Next, we have Mr. Sanket Desai, who is the partner indirect taxes at EY. He's also a chartered accountant by profession and a commerce postgraduate from Mumbai University. He focuses on the consumer and the retail sector and has more than 19 years of experience. Next, we have Mr. Rahul Kakkad, who is a partner with EY Direct Tax Practice and is also a chartered accountant and a commerce postgraduate from Mumbai University. He also focuses on consumer and the retail sector and has more than 18 years of experience. Welcome, Mr. Sanket and Mr. Rahul. Over to you, Mr. Paresh.
Good morning to everyone, and thank you so much, Palak, and thank you to each one of you for attending and to Retailers Association of India. I think clearly this is an historic budget. If you hear the Prime Minister, he had clearly given the hint one day before. And if we look at the next slide, he had actually mentioned that may Goddess Lakshmi bless the poor and the middle class. So whenever he gives a small hint, the result is always something big. So that came true. And what initially I'm going to talk about today for 10 minutes is around the policy. And then I will hand over to Sanket and Rahul for indirect tax and direct tax proposals affecting retailers specifically. So if you look at the global economy on the next slide, the global economy, while is growing slightly lower at 3.3% compared to 3.7%, what it was growing between 2000 and 2020. So I think in 2025 and 2026, the growth is slightly lower. There are new governments all over the world, leading to geopolitical shifts, trade effect, inflation, economic activity, and in fact, everyday Trumponomics is throwing up new challenges. It is literally becoming impossible to plan because of the global tariff evolution and uncertainty. So it will take some time to stabilize before cross-border tariff planning can be done. Focus on artificial intelligence continues, new models, and in fact, India will also have to soon come up with its own AI because of US and China dominating the world. I'm sure in the next few months, there will be a lot of focus on developing more and more AI models within India. US dollars is continuing to strengthen. Indian rupee has relatively fallen lesser compared to other economies, but still the fall is continuing, and the money flow towards US is happening, and also the demand for dollar is going up. So this is a lot to deal with the Trump's election and then the policies. In light of that, if you look at where India stands, I think on the next slide, India growth is still quite good, 6.4% real and 10% nominal. It is 3 times the advanced economies. So if advanced economies are growing at 1.8%, India is growing at 6.5%. So it is still very commendable. And it is also higher than the average of all the emerging economies, Brazil, Russia, China, and almost double that of the world. So I think we are relatively in a good space. If you look at the next slide, essentially, someone was checking with me whether this is enough for the 30 trillion vision which we have for Viksit Bharat. I think it is not enough. We need 8% growth. So I would like to give you some data. The finance minister has foregone almost 1 lakh crore in this budget in the personal tax. That is almost 7 to 9% of the total India tax collection. That is huge. And as an economist, typically we apply a multiplier effect of 5. So effectively, a 5 lakh crore consumption effect can potentially happen after assuming 80% goes in savings and only 20% out of the initial disposable income is actually getting into consumption. I think the effect is going to be huge, at least as per theory. Let's see what happens on the ground. And also, this can give 2% fill up to the budget. The 5 lakh crore over Indian budget can increase our GDP by 2% potentially. So that is the gamble which the government has played. And therefore, in spite of foregoing around 7 to 9% of tax, we are estimating upwards of 10% collection. So which were the sectors which did well last year? I think electronics, pharma, auto, steel, cement, chemicals, and petrochemicals. Construction also stood out. Financial sector, real estate sector, and professional services. The growth was very good. Forex reserves are still at a very comfortable position. They cover around 90% of India's external debt. So that is a very strong buffer. If you look at the next slide, in terms of what are the fiscal aggregates, the tax revenue is budgeted to grow at 11%, as I said. And in fact, the government expects the direct tax to grow at around 13%, 12.7%, more than indirect tax at 8.3%. So that is something which government is assuming that there will be a lot of buoyancy, a lot of income in the hands of people. And in spite of the liberal tax regime, the growth in tax, direct tax, will be 13%. And capital expenditure is budgeted around 11.2 lakh crore. In my view, it is decent. Some people were saying that a bigger 14 lakh crore, etc., could have been done. But I think the implementation also is important. Even if you can budget 11.2 and implement actually 11.2 lakh crore, that is a major victory for the economy rather than just budgeting something and not able to actually spend. So I think this is something good news, and that has ensured that a very healthy balance between boosting consumption and managing the fiscal deficit has been achieved. So we should compliment, I think, the government on this part. If you look the next slide, I think one important thing is there is sometimes a narrative that the private expenditure is going down. But if you look at the figures, the private consumption has actually grown from, it is actually growing from 6.6 to 9%. In fact, the private, from 4 to 7.3, sorry. And in fact, the private final consumption is the one which is giving the push to GDP. It is actually the gross fixed capital formation which has not happened, and that is the slowdown because of which the GDP slightly got impacted. And if you look at exports, even that is picking up. The contribution of net exports has actually turned positive, and this is a big news. It is actually 1.7 percent contribution of net exports as a percentage. So that's, I think, in my view, a quiet manufacturing revolution already starting to happen in the country. Last year, I think it was the manufacturing degrowth, which was a challenge because of which there was a slight degrowth in the economy, or not the growth as per what we wanted. When I say degrowth in economy, degrowth compared to what ideally we wanted. If you look at the next slide, I think I just want to spend 1 minute on this. I want to point out to you how big the allocation to water sanitation and rural drinking has been. So Jal Jeevan Mission allocation has grown from 0.23 to 0.67, a growth of 200% over last year, 195% growth. So that is quite a huge growth in the allocation for water mission, I would feel. And even the Atal Mission for Regeneration and Urban Transformation has seen a decent increase in the allocation. Go to the next slide. One interesting thing which some of you may have not noticed, over the last 5 years, government has been very successful in reducing the subsidiary expenditure as a percentage of nominal GDP. It has actually fallen from 3.56 to actually 1.07 as a percentage of GDP. And it is also budgeted to fall further. If you see, the fertilizer subsidy has fallen, food subsidy has fallen, and petroleum subsidy has also fallen as a percent of GDP. So that is something unique I thought I should point out. If you look at the sector impact, I think manufacturing will continue to get pushed through three ways. BIS standards to somehow control China dumping. Second, in terms of the increased import duty on some of the products. And third is to give some kind of PLI or manufacturing support to Indian industry. So this is the triangular in which the government is trying to push Make in India. Especially footwear and leather sector is going to see good schemes coming up. Toy sector is going to see a national plan for manufacturing toys in India, and food processing and large scale electronics and clean tech. These are the four sectors which will stand out for manufacturing push in India. One unique competitiveness which will be built in is by having an investment readiness index of states to motivate states also to enter into a competitive federalism. You can go to the next slide. The big news for each one of you on this call is also that the micro, small, and medium enterprises limit has been doubled. And in my view, this is huge. Micro is now 2.5 crore investment and 10 crore turnover. And medium is in fact 125 and turnover is 500. I think this is a step in the right direction. When we say micro, small, and medium in other countries like US, Germany, or China, we are literally talking about $10 million and above, or sometimes even companies having 5,000 crore turnover. So this is good for Indian companies to scale up and take advantage of the MSME sector benefits. So this is something which a lot of people will be eager to see how one can take advantage of micro, small, and medium enterprises. Infrastructure, clearly, as I said, positive news on the CapEx and Urban Challenge Fund. MSME we discussed. Clean energy, clearly there is a push. In fact, you will see a lot of semiconductor business and other clean energy things, and nuclear energy also getting a push up. AI, there is a push. Exports, I would like to call out. We would see continuous focus of government to push exports. I know there are a lot of bureaucracy issues which you may be facing in the day-to-day dealing, which also needs to be fixed, without which this remains on paper if the implementation is not appropriate. I think insurance sector has also got a push through FDI and income tax, which I think we will be discussed in detail. But I would like to say the big picture clearly is the reduction in the tax rates and the tax slabs to boost middle class consumption. And after many years, I can say justice has been done to this tax paying middle class, which has been a historic demand. And for the first time, we have seen this kind of a takeaway for the middle class. I think decriminalization of laws and rationalization of TDS is also a good step and in the right direction. So overall, to close my thoughts on the big picture, I think clearly the focus is on agriculture, MSME, investment, exports, with emphasis of job creation, skill enhancement, and innovation. In my view, both urban and rural consumption will go up because, in fact, rural consumption now accounts for almost 30 to 40% of the total consumption. So that is huge. We generally miss that. So the tier 3, tier 4 towns and villages have been consuming and spending, including on agriculture and electronics and so on. I think Make in India is going to continue with focus on toys, electronics, footwear, leather, etc. So overall, the budget is a healthy balance to pursue fiscal consolidation and boost consumption at the same time. However, I would like to say the effect will also depend on two important points. The first one being more important, how the global situation develops on the global tariff and the conflict situation in different parts of the world. And we should also look out for the new income tax simplified tax law, which the finance minister has promised us will be easy to read and will be far less number of pages. So let's hope that dream comes true. So with that, I would like to again congratulate each one of you on the call. I think it's a good budget overall and a good justice to middle class. So I will take a pause. We can, of course, discuss more as we go on. Thank you. Over to you, Palak.
Thank you, Mr. Paresh, for such an enlightening opening. Now I would request Mr. Sanket to take it ahead, Mr. Rahul to take it ahead.
Thanks, Palak, and good morning, everyone. As I think Paresh mentioned, I think the boost to the middle class. Can you go to the next slide, please? I think we'll start with the individual tax proposals. I think this was something which was not at all expected. I think we would have heard a lot. If you see the new regime slab rates, the headline is that no no income tax from 7 lakhs to 12 lakhs, right? That's a really welcome move. The rebate has been increased from 25,000 to 60,000. If you broadly see in terms of the tax savings under the concessional tax regime, we've had various scenarios from a person who's earning 12 lakhs to approximately 2.5 crores. The tax savings, if you see, are from 83,000 upwards to 1,43,000. So that's a big move, and I'm sure that will lead to more savings and obviously increase the consumption and spending powers in the hands of the individuals and obviously boost the retail sector. For a salaried person, total income up to 12 lakh 75,000, there should not be any tax payable, considering the rebate under Section 87A, along with the standard deduction provided under 16(2)A, which is approximately of 75,000. So net, I think for a salaried individual, there is no income tax till 12 lakh 75,000 rupees. Having said that, there is no change in the old tax regime. The message is very clear from the government that they want people to move to the new concessional tax regime and not opt for any exemptions or deductions availed under the old tax regime. I think that's been on the cards ever since they've introduced the new tax regime. And the current slab rates and the rates which have been prescribed for the new CTR, I think is a clear indication to what their preference is from a tax rate slab rate perspective. The new CTR, sorry, just go back, Palak. Sorry, Ruchita. It was proposed that the rebate amount will only be applicable to 115 BCA, which is the concessional tax regime. There is still ambiguity in terms of whether, as an individual, if I earn short-term capital gains or long-term capital gains, and if my income limits are up to 12 lakhs, whether I will get the benefit of nil tax up to 12 lakhs. So there is still ambiguity around that, and that's an area one which needs to be wait and watched. Moving on. There was obviously now moving on to measures to promote investment and employment. I think there was when significant economic presence applicability with business connection was introduced. There was a provision under the Act which spoke about that non-residents, no income should be deemed or accrued to arise in India if they're carrying out operations which are confined to purchase of goods in India for re-export. However, once SEP was introduced, explanation 2A was brought in, which kind of brought in ambiguity around the taxability of non-residents who are carrying business in India for buying and selling of goods, predominantly for exports. However, that has been now clarified to say that if the non-resident business is confined to purchase of goods in India for purpose of exports, it should not constitute an SEP and should not have any tax implications in India. This amendment is effective from 1st April onwards. One needs to wait and see that what will happen. While the memorandum spoke about it's a clarificatory in nature, the bills categorically mentioned that it is effective of 1st April. And it is a prospective change and not a retroactive change. So one will need to see what happens to the past years, while there may be arguments to support that this was always clarificatory in nature and should not have any implications on non-residents. This will surely kind of encourage non-residents who are trading in India and buying goods and for export purpose. Moving on. Another welcome move which as startup has been a big play for the Indian economy, and we know there are many startups in our sector as well. There is a benefit of income tax available for 3 years out of any 10 years. Your taxable profit is exempt up to 100%. The only hitch was that the benefit was available to startups who have incorporated prior to 31st March 2025. The government has increase the threshold sunset clause by another 5 years. So all startups who are set up prior to 31st March 2030 will now be available for the tax benefit. So this is a really welcome move, and you will see many, many more startups flourishing and setting up and availing this benefit. A scheme of presumptive taxation is extended to non-residents for providing electronic manufacturing facility. So this is also a welcome move, and I think to position India as a global hub for electronic system design and manufacturing, it is proposed to introduce a presumptive taxation regime, which will entitle non-residents who are providing service or technology to a resident company, which are established to operate electronic manufacturing facility or a connected facility for manufacturing or producing electronic goods in India. Up to 25% of the aggregate amount received will be on a deemed profit basis. Moving on. Uh, Carry forward of losses in case of amalgamation. I think currently, as per the law, there was a provisioning of uh, you know carry forwarding of losses. As per law, business losses can be carried forward up to 8 years. However, if two companies merge and they could probably recreate the loss and probably have a fresh life of 8 years post amalgamation, was probably an evergreening of a loss for a fresh period of 8 years. What is now being said is that if two companies merge, then possibly evergreening of losses may not be available, and the loss period available to the existing company will be after merger will be only for the balance period of which was entitled to the company. So in an example, company A and company B. Company A had losses and they were for the past 4 years. Technically, company A could be eligible to claim losses for only the next 4 years. People used to typically merge company A into a profitable company, say company B, and ensure that the loss of say 100 in that example is eligible to be set off for a fresh period of 8 years instead of the balance period of 4 years. Now the government has gone back and amended the provisions of 72 and 78 to say that the loss will not be allowed for a fresh period of 8 years and now be only restricted for the balance period of 4 years, assuming the merger would have not happened. However, the proposed amendment has probably certain interpretations and certain viewpoints that can be taken with effect to appointed and an effective date. Appointed date in a merger is the date on which you put in your scheme that you would like the amalgamation stroke merger between two companies to be effective from what date. Effective date is typically the date on which the NCLT passes an order. So I've laid down few examples. If I have to say that first example is your appointed date is 1st April 24 and the effective date is October 24. Whether the proposed amendment is applicable or not, point of view is to take that ideally it should not apply and a fresh period of 8 years from the date of amalgamation should be available to the company. Second example is where the appointed date is 1st April 24. However, the order is received in say probably on 1st May 2025, which is after the amendment is kicking in. Whether a view can be taken that the losses should be eligible for fresh period of 8 years, I think there are some arguments that one can explore. The third scenario is probably 1st April 2025 is the appointed date, and assuming the order is received on 1st October 2025, given that both dates are post the amendment kicking in, whether the fresh period of 8 days is eligible or not, I think answer to that probably is no. Having said that, so any companies who are looking to evaluate, any mergers, etc., within the group, probably this is the right time, and probably they may revisit and try and see what kind of appointed date and effective date that they can play with. There's a good opportunity out here as well for companies. Moving on. Uh, Rationalization and simplification is the next theme. Section 275 laid out, in terms of certain timelines on imposition of penalties in various cases. There were various timelines which were set to pass the penalty order for the tax authorities. In certain cases, it was 6 months, certain cases, it was 1 year, so on and so forth. And it was quite difficult to track multiple time barring dates effective, from both the assessee's perspective and the tax authorities' perspective. It is now brought in, change has been brought in to say that penalty order should be passed within 6 months from the end of the quarter in which the connected proceedings are passed, or the order by the ITAT or Commissioner Appeals is passed, or a revision is passed, or a notice for imposition of penalty is issued. This amendment is likely to be effected probably from 1st April 25. Having said that, it kind of brings in terms of certain ambiguity. I will lay down that through an example. Where supposing an SSE has received a commissioner order in say April 24 and no appeal has been further filed by the SSE before the tribunal. Under the current provisions, what the Act says that the tax authority has to pass uh, the penalty order from 1 year from the end of the financial year in which the order is received. So in our case, the time limit for the authority was up to March 26 because the order was received in April 24. So we have to look at the end of the financial year, which is 31st March 25, and 1 year from then is 31st March 2026. Having said that, in a current scenario with the amendment kicking in, the new revised timelines would be 6 months from the end of the quarter in which the order is received. So for an order received in April 24, the end of the quarter is June 24. 6 months from there is 31st December 2024. So having said that, obviously there will be certain cases, nuances where by getting in this order, certain time lapse would have gone and probably orders may not be valid. We believe certain kind of relaxations may be brought in or clarifications may be brought in or certain additional time may be given by the government to ensure that such procedural lapse don't happen. But if not, then there could be a good area to evaluate and see if for any of our penalty orders, we can take the argument of whether the order is not, whether it's time barred and not valid anymore. Block assessment in certain cases, I think they've added the term virtual digital assets to the definition of undisclosed income under section 158B. And the time limit to complete block assessment have been increased from 12 months from the end of the month to 12 months from the end of the quarter in which the authorization for search or requisition has been executed. This amendment is effective 1st February 2025. From a transfer pricing perspective, they brought in an option to elect TP assessment for a block of 3 years. Currently, TP assessment are undertaken on each financial year basis on a standalone basis. There is no provisions to get an assessment under block. Amendment has now proposed to conform to international standards on TP assessments and to reduce the compliance burden on both the taxpayer as well as the administration on the TPO as well, where transactions are same or a similar nature. Elective option will be provided to the taxpayer upon reference made to the TPO for a particular financial year. Option not available for cases involving search and seizure. Option to be exercised by the taxpayer within such time frame as in may be prescribed. So we are awaiting certain more clarifications rules in this regards. The TPO will then verify and declare if the option is valid based on the conditions that may be prescribed. If the TPO declares and the option exercised is valid, the ALP determined for one particular financial year will also apply to the 2 consecutive financial years for similar transactions. The assessing officer will recompute the total income for 3 years in conformity with the ALP determined by the TPO and the DRP, and the adjustments one will be done within 3 months from the end when the assessment is completed. This amendment is effective 1st April 2026. Whether the one view is to say that it will be applicable for all assessments which are live as on 1st April 2026. Other view probably is stemming is whether it will be applicable for financial year starting 1st April onwards. So there is no conclusion on that, but that's an area of argument which people are exploring as of now. Expansion of scope of safe harbor rules. With a view to reducing litigation and providing certainty, the scope of safe harbor is now proposed to be expanded. Rules detailing the expanded coverage will be prescribed. So, I think moving on to TDS provisions, and I think the government has tinkered and kind of with both the rates as well as the thresholds. I think they've changed quite a few of the rates last year. And from perspective of ease of doing business and better compliance by taxpayers, they've kind of rationalized certain rates and increased certain thresholds, applicability to TDS provisions and effects from 1st April 2025. Probably key ones are around the rental income. If you have to look at 2,40,000 during the year, now the threshold limit is 50,000 per month or a part of the month. I think that's one of the key changes that one needs to look at. And it is not 6 lakhs per annum on a cumulative basis. It is 50,000 per month that one needs to look at. So in assuming if you don't pay a rent, probably say for January, February, March, for three months you're paying a rental of 1 lakh each, but the overall threshold doesn't qualify more than 6 lakhs, you still be applicable because your monthly rental is exceeding the threshold of 50,000. So TDS provisions will surely kick in out there. So I think these are welcome moves, and probably if you have to look at TCS on sale of goods was brought in. I think they've kind of done away with the 1.1%, which was applicable on sale of goods exceeding INR 50 lakhs. Now it is proposed that TCS will not be applicable on sale of goods effective 1st April 25. However, TDS under 194Q will still be applicable when good value or sales value is exceeding 50 lakh rupees. Will continue to apply. Removal of higher rates of TDS and TCS for non-filers of return of income. This under 206 AB and 206 CCA. There was a provision to say that as a payer, if I had to validate that whether the opposite person has filed returns or not, and this was a very cumbersome while for all companies when they were doing their AP processing payments, whether the parties have complied with this condition or not. And in case of non-compliances, they have to deduct TDS at a higher rate. Specified person check is what we call it. The government has done away with it. It's a really welcome move. And they said that the higher rate of TDS will be or TCS will only be applicable in case of an invalid PAN or no PAN. So I think that's an easier check rather than to check whether the companies have complied with filing of return or not. Certain other incomes, other amendments pertaining the threshold limit on TCS remittance under the LRS scheme on overseas store program packages have been increased from 7 lakhs to 10 lakhs. This is another welcome move. Tax will not be collected on remittance out of where loans, student housing loans, student loans is obtained from a particular financial institution for purpose of pursuing education overseas. Both these amendments will be effective from 1st April 2025. Certain changes on the tax administrations, extending the time limits for updated returns. As per the existing provisions under Section 139(8A), an updated return can be filed up to 24 months from the end of the assessment year. For updated returns filed within 12 months from the end of the assessment year, additional income tax and interest aggregating to 25% of the total demand which has been payable, you have to pay. So assuming 100 was the demand, then you need to pay 125 and you can file an updated return. And within 24 months, it was 50%. They have kind of extended the timelines to say that now we can file with up to 48 months after the end of the assessment year. If returns are filed within 24 and 36 months, then additional interest and tax percentage is 60%. And within 36 to 48 months, the threshold has been set at 70%. This probably will really help people who have probably missed out on certain claims, etc. The opportunities to go and revise and file an updated return by paying a nominal amount, additional amount, rather than paying interest at a higher threshold and then protecting yourselves against penalty as well. Updated return cannot be furnished once a reassessment notice is being issued after 36 months from the end of the relevant assessment year. However, it can be filed if the reassessment proceedings have been dropped before 48 months. Then we can still explore filing the updated return. This amendment will be effective April 1st, 25. Accordingly, updated return can now be filed for assessment year 21-22 and subsequent years. I've kind of laid out in terms of an example in terms of what kind of penalty, what kind of updated tax and interest that needs to be paid under various scenarios. Extending that processing period application for seeking immunity for penalty and prosecution. So in a case currently, after an assessment, if a taxpayer wishes not to file an appeal for reasons, if the amount is not so significant or not large, or for some other reasons, it wishes not to file an appeal before the higher forums, there was a provision that you could file for immunity from penalty and prosecution with the tax authorities. Uh, the current timelines was only restricted to 1 month from the end of the month in which the application was received or order was received. So now they've increased the timelines from 1 month to 3 months. So this is another welcome move, and it gives probably a larger window for the taxpayer to evaluate and make a claim of immunity before the tax officers. Next slide, please. Exemption for prosecution for delayed payment of TCS. So I think this is also a welcome move and probably was left out in the previous budget when prosecution for delayed payments of TDS was introduced. However, TCS for somehow was left out. So this has been also brought in for any delay in terms of payments for TCS if is being deducted and deposited before the quarter return has been filed, then there may not be any penalty there will not be any prosecution will be initiated in the hands of the taxpayer. So this is also a welcome move, and this sinks in with the whole TDS and the TCS provisions. Having said that, I think I've covered the direct tax proposals which were announced. I will now hand it over to my colleague Sanket, who can take you through the various indirect tax proposals. Thank you.
Thank you so much, Rahul, for extensively covering the direct tax proposals. Of course, this time the highlight of today's budget, this year's budget, was the major relief which came for the middle class in terms of income tax exemption up to 12 lakhs of income, and that has been the talking point everywhere, including social media and everything. But on a serious note, this has been really a great relief for the middle class, and the entire salaried class of employees and the consumer, they were really looking forward to these changes. Uh, Going with this theme, for indirect taxes also, some attempt has been definitely made in this budget to pass on the benefit to the consumer. Uh, as you can, I mean, before we start on the indirect tax proposals, I would just like to highlight that uh, Union Budget 2025, or any budget for that matter, GST rate amendments is not a part of the budget because GST rate amendments only happen now through the GST Council, which is basically an association, or it comprises of all state finance ministers, and through consensus, they decide what will be the GST rate for a particular product. And that is exactly why in this budget we will not see any announcements on GST rates. But the good news is that there is definitely a lot of work going on GST rate rationalization, and I will cover that topic specifically after I first summarize all the indirect tax proposals that have been announced in the budget 2025. Okay, so starting with the GST related announcements. So of course, not related to rates, but other proposals which have happened. So there was one Supreme Court decision of safari retreats which came in a few weeks back, just before the budget, and this again was a specific judgment on input tax credit eligibility for civil construction activities. And one of the major aspects that was being that was being examined by the Supreme Court, and that was pending before the Supreme Court, was that if there is a if let's say a company, more specifically in this case, it was a mall, which was setting up its entire mall infrastructure and the shops and everything. They had incurred a substantial amount of expenses for setting up the mall. But because of the restriction in the law, they were not able to take the input tax credit of GST. Uh, and a writ petition was filed challenging the constitutional validity of this restriction. And in the Supreme Court decision, the Supreme Court highlighted regarding I mean, they went into the technical aspects on what is plant, what is machinery, and there were I mean, two references in the GST Act. In at one place it was mentioned as plant and machinery, and the other case it was mentioned as plant or machinery. So where it was plant or machinery, one possible interpretation was that even if what I'm incurring, for example, I'm incurring civil construction activity, and if it qualifies as a plant but not machinery, still any civil construction for own purpose or for own use could be eligible for credit. So that was sort of some lacuna in the law, in the provision, which was also highlighted in the Supreme Court hearing and the ruling. But now the government has plugged that inconsistency in the GST Act, and now they have said that, and it's a retrospective amendment which says that plant or machinery will now be amended to plant and machinery. So in order to qualify for input tax credit, it should qualify as plant and machinery. So for just to give an example, and something which qualifies as plant may not qualify as machinery, like a shopping mall. There could be an argument that a shopping mall is a plant but not machinery. But so that was the first amendment. So net to just summarize it, kind of uh, uh, removes the inconsistency in the GST Act, and the impact or the possible impact of the Supreme Court decision has now been negated by this amendment. So that is first. The second is that is more of a procedural amendment. Few months back, in fact, in the last year, the government clarified that input service distributor is a mandatory compliance to be done by any company which has an office at one, I mean, or a head office or an office, and it has multiple other GST registrations within India. So in those cases, whatever common expenses or invoices are booked in the office, like audit fees or consultancy charges, so on and so forth, all those should be, the GST credit on that should be distributed to the other GST registrations. Now they have also clarified and made some changes in the provisions to say that even GST which is paid under reverse charge will be covered in the scope of ISD or input service distributor, which means if you pay GST under reverse charge, let's say on royalty or any import of services, even that GST credit you need to distribute to the other locations. So this is more of a clarificatory amendment which has happened. So that's the second one. The third important amendment which has happened is with respect to what we call as IMS, or Invoice Management System. Now, this IMS has not been introduced for the first time in this budget. The IMS functionality has been launched a few months back under the GST law, I mean, on the GSTN portal. What it essentially says is that uh, today, when a company receives invoices from its vendors, what a company has to do is that they have to check whether that invoice is also appearing on the GSTN portal, more specifically GSTR 2B, and an invoice to invoice matching is done of what data is available on the GSTN portal versus what is booked in my purchase register or my books of accounts. And only when it is matched we take input tax credit. That is the matching, input tax matching concept or the requirement. Now what they have said is that under IMS, the company needs to not just match, but also we need to accept, reject, or uh, and say or take a pending action on all the invoices which are appearing on the GSTN portal at a invoice to invoice level uh, on the purchase side. Similarly, other documents like credit notes debit notes or any upward or downward amendment in credit notes, even those should be accepted or rejected. And this has to be done on a real-time basis. So the purpose of doing this is that when we take input tax credit, if we accept the GST and I mean the GST charged by the vendor, then only the credit will flow. If we say it is rejected or it is pending, then the input tax credit will not come into my monthly GST return, and it will show as either rejected or pending. So it will match on a real time basis, and the requirement is to report this on a real time basis, invoice to invoice level. Now obviously this kind of a requirement uh, cannot be done manually, especially when it comes to large organizations or even medium sized organizations which have multiple transactions, huge number of invoices. We can't sit and take those actions one by one. And that is why there is a need to have an automation, a solution which can automate these processes and have certain rules that if certain criteria is matching, everything is matching, then automatically it will say as matched. If let's say some invoice is appearing on the government portal, but I have not yet booked in my books of accounts, then it should go as pending. Okay. Or if some invoice appears on the government portal, but it is not pertaining to our purchases, we don't know where this invoice is coming from, we never received this invoice, then we could even reject that invoice. So on and so forth. So that those kind of actions will now need to be taken. Today IMS is not mandatory for everyone, it is optional. Okay, but very soon it is likely that they will make this mandatory. They may introduce this on at a slab level, but definitely we can see the future that IMS is going to be a reality, a mandatory requirement for everyone. And the action point for everyone, all the sector, is that we should be geared up for this important change. And we will cover this in the next few slides when we complete all the budget proposals. Yeah, we can go to the next slide. Okay. The other interesting amendment which has happened is what they call as track and trace mechanism. So track and trace mechanism means what? Basically, the government wants to track and trace certain products in certain industries, where they want to check whether the products which are being sold, they are actually going to those customers, and whether those customers are further selling, and they want to track those products. This measure or this drive is to ensure that there is no fake invoicing involved, or GST is being properly paid on those products. And right now they have not notified which goods they want to cover here, but we expect that it will not cover a big list of goods. Possibly they may cover products like tobacco or pan masala or those kind of products where they would like to do the track and trace. And if this is not complied, then there is also a penalty which is being proposed. So this is another important, interesting development. Uh, Another important point, and this is relevant for everyone all companies or organizations who have a GST registration, and sooner or later, or we would have already received orders from the GST authorities where only penalty has been charged. For example, tax interest has not been confirmed in the demand in the order, but only penalty has been charged. So in those cases, if we had to file an appeal against the penalty order, only penalty order, there was no requirement to pay in do any pre-deposit, mandatory pre-deposit for filing the appeal. But now they have said that if there is a penalty order, then you should pay 10% of the penalty amount as a pre-deposit while filing the first appeal, and another 10% while filing the second appeal, which will go to the tribunal. So before this, there was no such requirement. The pre-deposit requirement was only for cases where tax has been demanded. So 10% of tax and 10%, so on and so forth. So now it is for penalty as well. So that is the second important amendment on this slide. The third important point, and this is also very interesting, and this is a result of representation done by the trade, uh, and this is on vouchers. So vouchers are basically instruments, or they are basically documents which are issued, which entitles the customer to purchase certain goods by redeeming that voucher, goods or services. So for example, let's say a shopping, I mean a company which is engaged in sale of goods through its outlets, retail outlets, it issues a gift voucher to customers, which any customer would buy, and possibly he may gift it to somebody, or a corporate may buy and it may gift it to its own employees, or even this very popular uh, portals where e-commerce platforms which also sell these vouchers. There was an ambiguity on whether when a company sells vouchers to any customer, whether that attracts GST or not. Okay, and there was some litigation already going on this. Uh, the government has clarified that this is not a supply only under GST. So when we issue a voucher, there is no goods or services. Voucher is basically neither goods nor services, and GST only applies on goods or services. I mean goods and services, or goods or services, but not on something what we call as a actionable claim. So the government has clarified that vouchers is neither goods nor services. It is like an actionable claim, and therefore no GST. However, when the voucher is redeemed, so let's say some customer has bought a voucher, a 10,000 rupees voucher from a very popular e-commerce platform, and tomorrow we want that customer buys something online using that voucher. Okay, so whatever it buys, for example, it buys certain clothes, the customer buys maybe a mobile phone or anything, whatever they buy, whenever they buy that, they will not pay anything because there is a voucher. So let's say the shopping is done for 10,000 rupees and the voucher is also for 10,000. The customer will not pay anything. However, uh, that transaction of 10,000 rupees, on that GST will need to be paid by that seller, whoever is selling the goods, because they will collect the voucher from the customer and they will get that voucher redemption claim. Okay, so GST will apply on the goods or services that are supplied under the voucher. So this is an important clarification which came in, and the government has clarified that, and in the GST law they have removed certain provisions relating to taxability of voucher, of time of supply, and all those related provisions, because now these provisions are no more required. They have become redundant because voucher itself is not taxable. Uh, okay. Uh, The other important amendment is for credit notes. So in credit notes, what happens is that, credit notes can be issued for multiple purposes. The most popular reasons for issuance of credit note would be sales return. So if we have sold the goods and my customer is returning the goods, then we have to issue a credit note. It could also be for post-supply discount, which is given, any discount given after sale. It could also be for price differences, I mean rate differences. Okay, so various types of reasons. Uh, Before this budget, there was a requirement that if a credit note is issued for post-supply discount, then it is my responsibility to ensure that my customer reverses the input tax credit. If he reverses input tax credit, then only I will get the GST credit note benefit or the deduction. Okay, because there cannot be double benefit. I claiming GST benefit as well as my customer also claiming input tax credit was not allowed. So there was a specific provision for credit notes for post-supply discount. But now in this budget, what they have done is they have introduced this for all types of credit notes, not just post-supply discount, but all types of credit notes. So this is also an important amendment which has taken place. Yeah. Uh, Now we move on to customs. Okay. So what is the broad level theme, or what we can observe looking at the customs amendments which were announced, or proposals which were announced? So two things mainly coming out. One is customs duty rate rationalization, with keeping Make in India in mind. Okay, so there have been changes in the duty rates for multiple sectors, and we will discuss those sector wise as well. But the theme is to promote Make in India. They want to encourage manufacturing in India. They don't want companies to just do assembly in India, import something, I mean, semi-finished good, just do small assembly and then sell. They don't want companies, they don't want to encourage those activities. They want companies to do hardcore manufacturing in India. So that is the theme. And because of this, what they have done is that for those products, they have increased the customs duty for finished goods. So if we import finished goods in India, then the customs duty rate will be higher. But if we import the raw materials required for manufacturing, then the rate has been reduced. So naturally, this will encourage companies to import raw materials with a reduced customs duty rather than importing finished goods with a higher customs duty. So that's the first theme. The second theme is, of course, ease of doing business. And we will delve into that, what exactly they have done as far as ease of doing business is concerned. The first amendment that has happened, proposed in the with respect to ease of doing business, is that in customs, there is I mean, this is a very common situation that some imports, imports are done by filing bill of entry, and every bill of entry needs to be assessed by the customs authorities. Okay, so in certain cases, the customs authorities do not do final assessment, they do provisional assessment. What happens when they do provisional assessment is that you can clear the goods, you can pay the duty, that's fine. But if your bill of entry is provisionally assessed, then it gives the power to the customs authorities to come back to you and and challenge that, or even raise issue notices to you, or raise additional demand for any period, indefinite period, because it is provisionally assessed and there is no time barring involved. However, if it is finally assessed, then there is a limitation period which kicks in. So if it is a normal limitation period, it is 2 years. Otherwise, it extends up to 5 years in case of fraud or suppression of facts. But in any case, it will never exceed 5 years. But for provisional assessment, there was no such time limit. Now, there are many cases, for example, related party imports when it comes to SVB, or matters under dispute, where there has been a dispute where company is importing with some customs exemption and department does not agree. They may do provisional assessments in such cases. So now they have said that any provisional assessment should be completed within a period of 2 years, which can be further extended by 1 year. So maximum it can be 3 years, which is good news. So now at least there will be some time limit for closing a provisional assessment. For pending cases, time limit to apply from the date of assent of the finance bill. Of course, for this provisional assessment, uh, if the matter is sub judice, it is pending before some court, let's say tribunal or a high court, or some stay has been granted, then that 2 year period, or that time limit will be counted from the date when that order is issued, or the reason to do provisional assessment ceases to exist, or it goes away. From that day, you will count the time limit of 2 years. So this is about provisional assessment. So again, a welcome move towards ease of doing business. The other important amendment is with respect to voluntary revision of uh, post clearance activities. So what happens is, let's say we have imported goods, we have filed a bill of entry, paid the customs duty. Let's say after a few months, or maybe in future, we realize that there has been some error while computing the customs duty, either classification error, exemption has been taken wrongly, or it could be the other way around also, that we have paid excess duty. It could be multiple issues where post clearance of the goods, the company wants to do some revision. Uh, Today, uh, uh, if that had to be done before this budget, the only way to do that was to just I mean, pay the additional customs duty by filing a challan, which is called as a TR6 challan. But this was more of a manual activity, and it was this additional payment of duty done was not getting reflected on the ICE Gate portal of the government. And because of this used to create a lot of issues when it came to assessments and litigations relating to customs duty. And even for claiming input tax credit of IGST paid subsequently. What the government has now done is that they have introduced a provision to enable companies to do voluntary revision in customs documents after clearance. So we have, let's say, imported goods today, cleared the goods, paid the duty. After 3 months, we want to change. Then there will be a mechanism to file for amendment, revision. If there is additional customs duty, you can pay additional customs duty with interest. And here the important point is that there'll be no penalty if you do this voluntary. And there will also be, I mean, the other way around. For example, if we have paid excess duty, then we can even revise the entry saying I have paid 100 rupees, but actually I should have paid 80 only. So I will revise it to 80 rupees of duty, and which means I am eligible for a refund claim of the balance 20, which is 100 minus 80. So when I do that revision claim, that itself shall be treated as a refund claim. So then I'm eligible for claiming this refund from the government also. Uh, so this is also a good amendment. Along with this, I would also like to highlight that on 23rd of December 2024, last year, the government issued a custom circular, which also was on the same topic. There they enabled, they said that we will have a mechanism, online mechanism to enable companies to pay this duty interest for the past period. Okay, so somewhere we will have to wait for the mechanism to come in, and we will have to read this new provision along with the custom circular. And then the actual impact on the companies, what needs to be done for the past period, can be assessed. So this is also an important amendment, very relevant for companies who are engaged in import of goods. Another point which should be noted is that there was a settlement commission which was there under the customs law. Settlement commission is a authority to whom you can approach for just settling the cases. Suppose there is a demand and duty, interest, penalty. So you could approach the settlement commission saying that I want to settle the case, and please waive some part of the penalty or full penalty, so on and so forth. Uh, Now they are saying that they will be discontinuing with the settlement commission. It will cease to exist from April 2025, and no application to be made after April. And they will also set up an interim board to deal with pending applications. Okay, now we come to the duty rate changes for customs duty, and we will discuss this sector wise, more specifically for the consumer and retail sector. Uh, the first important point to note is that, as I said, Make in India theme. Uh, so what they have done is reduction in basic customs duty to support domestic manufacturing, value addition for certain specified goods. So certain sectors like critical minerals, textile products, electronic goods, capital goods for EV battery, mobile phone battery manufacturing, all these sectors, they have reduced the customs duty. They have also made some changes with respect to some cess and levies. Like some products are they have covered under AIDC, or agriculture infrastructure and development cess, and there they have exempted social welfare cess. So the net effect of these amendments is that the effective duty rate remains the same, but they have ensured that for any product, if AIDC is applicable, then social welfare surcharge will not apply. And if social welfare surcharge is applicable, then AIDC shall not apply. So both levies will not apply at the same time. But this net it does not impact the effective duty rate. Okay, so we will now just look at, just go to the previous slide. First sector is marine sector. So for marine sector, they have reduced the customs duty for certain products. One is frozen fish paste for use in manufacture of surimi analog products for export. So again, this is good. I mean, so they are encouraging manufacturing for the marine sector, even fish hydrolysate for use in manufacture of aquatic feed. So not just all the marine sector also, but for the aquatic feed. For that industry also, there are some reliefs in terms of manufacturing in India. You can go to the next. When it comes to leather, they have reduced the or they have exempted rather the customs duty on wet blue leather. So wet blue leather is one type of leather which is used in industries such as footwear industry and other industries. So again, a welcome move. Gems and jewelry sector. So for gems and jewelry sector, what they have done is that for platinum findings, which you can see as the second row, they have there is a substantial reduction in the customs duty from 25% to 6.4%. Similarly, articles of jewelry other than gold, silver, platinum findings. So gold findings, there was already a reduced rate, which was 6%. Earlier prior to this. But for platinum findings also they have introduced this now. And other articles of jewelry, meaning other than gold and platinum findings, the reduction is from 25 to 20%. Similarly, articles of goldsmith and silversmiths wear. So basically, any articles which are used by goldsmiths and silver, all the jewelers who are actually manufacturing in India, all the articles that are used by them, silversmith and goldsmiths wares and parts of those, the customs duty has been reduced from 25 to 20%. Similarly, for gold bars and silver bars, there has been a reduction from 5.5% to 5%. So, to summarize, for gems and jewelry sector, there has been some, amendment and reduction in the customs duty. And go to the next. Okay, electronics goods sector. Electronic goods sector, one interesting point to note is that they have this time picked up interactive flat panel display module. So interactive flat panels are basically those big screens which are used in universities or in conferences, I mean corporates also, which have a touch screen or some kind of a interactive functionality. It could be with or without touch, but big screens basically which are used for these seminars, lectures, or even for educational purposes. Uh, so what they have done is that they have they have reduced the customs duty on the raw materials that are required to manufacture these panels, interactive flat display panels. However, they have increased the customs duty for the finished goods. So if you see the fourth row, interactive flat panel displays into bracket completely built units, the duty rate has been increased from 11 to 22%. However, the first three rows, if you see, open cell for interactive flat panel display, there is a reduction from 16.5 to 5.5. Again, touch glass sheet and touch sensor PCB for manufacture of interactive flat panel display module. Again, there is a reduction to 5%, 5.5%. Inputs and parts of the open cells for use in manufacture of television panels of LED and LCD TV. They're also from 2.75% to 0. Similarly, inputs and parts for use in printed circuit boards or PCB, which are used uh, in this industry for specific part of cellular mobile phones. Okay, there also there has been a reduction from 2.75% to nil. So again, for electronic goods industry, make in India, manufacturing in India has been promoted. Now we come to the other goods. So other goods are essentially, uh, the household, day-to-day household items which are used by the consumer. For example, seats, whether or not convertible into beds. So these are all those furniture items or sofas or seats. There has been a reduction from 27.5 to 25%. Other furnitures and parts, 27.5 to 25%. Mattresses, supports, articles of bedding. So again, household items, durable items which are used in the houses, there has been a reduction. So again, this is a benefit for the consumer. Uh, Luminaires, light fittings, lighting fittings, including searchlights. So lights fittings which are used in the houses or other areas, other premises also, 27.5% to 25%. Uh, the last point on this electronic parts. So uh, parts of electronic toys. Okay, so there are many companies who may be importing parts of electronic toys. They have given a customs duty exemption or a concessional customs duty for parts of electronic toys, which continues, which is a substantial reduction I mean, substantial concession, about 25%. But if you are importing parts of electronic toys for manufacturing, then only this concessional customs duty applies. But if you are importing parts of electronic toys for other purposes, you are not manufacturing, for example, you are trading, then this duty concession is not available. Okay, so they want to encourage companies to import and use it in the manufacturing activity. That is the other point. Last point, last line item on this in this table is all dutiable goods imported for personal use. So whatever are as a consumer, if you import any goods for personal use, there was a duty of 38.5% flat. So now it has been reduced to 20%, which is also again good news for the consumer. Uh, on one item they have slightly increased the customs duty. So it basically they have introduced the I mean a tariff or value based customs duty based on the value or per kg. So it is for knitted fabrics where it is 22% or 126 rupees per kg, whichever is higher. So this is a summary of uh, the customs duty proposals and GST proposals. I will now move on to the next area, which is, I mean, I'm just taking a snapshot of what has happened in the last 3 months as far as GST is concerned, and what the industry should look forward to in the next 6 to 9 months in terms of GST readiness or amendments or advocacy opportunities which you can approach to the government. Yeah, go ahead. So first is valuation for related persons. So if you have any related persons transactions, especially when it comes to import or even domestic, okay, they have clarified now that so the clarification is actually for import of services, where they have said that if you are receiving services from a foreign company who is your related company, related party, uh, then if you are anyways eligible for full input tax credit, then whatever value you declare will be considered as the fair price, and they will not challenge your valuation. Because on this point there was a lot of litigation going on, that authorities were challenging the value for related parties, saying that you should have paid GST on a higher value. But if you are anyways eligible for full input tax credit, there is no loss to the government revenue. And that is why they issued this circular saying that whatever value you declare, we will accept it, provided you are eligible for full input tax credit. While this circular is for import of services, it is possible to I mean explore that we can apply it to even domestic transactions when it comes to related party. So any supply of goods or services between two related persons. So far as full input tax credit is available to the buyer, there is a possibility to argue that whatever value is declared should be accepted as the correct arm's length price. Yeah. The other amendment is with respect to reverse charge mechanism on services. So we should be aware about it. Why I'm picking up this specifically is because sometimes these amendments may get skipped and it may result in unnecessary liability or non-compliance penalty at a subsequent date. What they are saying is that sponsorship services which are provided by body corporates, till now it was under reverse charge. So now they have said that it should be under forward charge. Okay, so services provided by any person to a body corporate or a partnership firm. Okay, what it says, the old entry, tax to be paid under reverse charge for the corporate by the body corporate, even if the service provider is a body corporate. The new entry says any person other than, I mean, a body corporate, services received by any body corporate or partnership firm, the new entry says tax to be paid under forward charge by the body corporate. So this is an important amendment. The other important amendment is more from a compliance perspective, and it says that it says that if there is an amendment in the GSTR, I mean, if you have to file GSTR 1 and 1A returns, there is a requirement to give the HSN wise list of goods. Uh, and now they have made it mandatory for to give the HSN summary separately for B2B supplies and separately for B2C supplies. They have also said that there will be some kind of a drop down list of HSN codes which will have to be selected while filing the GSTR 1 return. So this is being implemented in a phased manner. Uh, Till now, I mean, when we started GST compliance in 2017-18, in the initial years, this HSN summary was not a mandatory requirement. Then they made it as a mandatory field. Now they have brought this further to say that you have to give bifurcation of B2B, B2C. Okay, so this is also one compliance or procedural related amendment which has happened. Okay, another important point is with respect to amnesty scheme. So this GST amnesty scheme was introduced by the government a few months back. And why I'm picking up this topic specifically is because uh, the amnesty scheme is still live and we can still apply for the amnesty scheme. Okay, we can pay taxes till 31st of March 2025 under this amnesty scheme. The period covered here is 1718, 1819, and 1920. So first 3 years of GST, you can clean up if something has been missed and we have received negative orders and all. So it is important to assess all those open litigation cases and to see whether it makes sense to pay the tax under amnesty scheme, because you will get waiver of interest as well as penalty under this if you pay 100% tax. Uh, there are certain nuances in this scheme, like suppose a case is under there is allegation of fraud or suppression of facts, then there could be it may not be eligible. Okay, so there is some procedure also that if you want to avail this, first you have to withdraw the pending appeal. And if there is any, you once you apply for amnesty, you cannot claim a refund of any excess tax. So all those conditions are there, but definitely it makes sense to apply to explore amnesty for all the pending cases, especially for 1718, 1819, and 1920. IMS, we already discussed that there is this amendment which is happening. I mean, it has already taken place, and right now it's not mandatory, it's optional. But IMS is an important compliance change which has happened, impacting all the companies. We discussed at length in the beginning of this session. So I will not delve into all the details on this slide. But what couple of important points what I want to highlight is that uh, this has to be done on a real time basis. We have to take actions like accept, reject, or pending for invoices. There are certain transactions for which pending is not allowed. You have to either do only accept or reject. So these are credit notes or credit note upward amendments or credit note downward amendments where original credit note was rejected, so on and so forth. Uh, so the recipient is allowed to take action of accept, reject, or keep pending till he files the monthly GSTR 3B return. After filing the 3B return, all accepted, rejected, or records will move out of the IMS dashboard. Uh, okay, so these are some important points. You can go to the next. What are the potential issues? One is taking action on every invoice could result in substantial manual activity, and there is hence a need for automation. No option to accept or reject partial input tax credit. So it could be an issue for cases such as short receipt of goods, excess amount billed by the vendor. So these are some business nuances or some specific issues which can impact. If a credit note is rejected by the customer, then credit note deduction is not available. Okay, so if my customer rejects a credit note which I have issued on IMS, then I will not get the credit note benefit. And there is no mechanism prescribed to re-upload the same credit note. So this is also one important note. And that is why IMS process would require change management. It will require a lot of training, knowledge sessions, communication with vendors, customers, your procurement team, sales team, internal stakeholders, also changes in your ERP or accounting software. So system related changes will also need to be done to be compliant with IMS. Okay, the last section which I would like to cover was on indirect tax advocacy areas. So these are some areas which we should look forward to in the coming months. Uh, the first point is on post-supply discounts. So what happens in post-supply discount is that today, and this is a live litigation going on for many companies today, when we issue a discount after sale, in many cases the discount may or may not be agreed prior to sale, because discount schemes keep on changing all the time. In the GST law, there is a requirement that if I am issuing a post supply discount and claiming a GST reduction on that, then the discount should have been agreed prior to sale. So there is this is a business complexity, and this it is very difficult to comply with this condition for many companies, and hence this is an opportune time for companies to approach the government and make a representation that this condition should be removed, because this is impacting the consumer and retail sector. The other important opportunity, and if you may see the finance minister, there was one interview of the finance minister yesterday where she spoke about GST rate rationalization. Of course, nothing was announced in the budget, but this is post the budget. She has given an interview, and in that she has said that we are seriously looking at GST rate reduction for many products, and the focus really is on goods which are used by the consumer on a day-to-day basis. So the essential items, which may include food, processed foods, and those products, and maybe others also. Why they are doing this, or what gives them the buffer or the capability to do this on a substantial scale, is because you would be aware that there is something called as compensation cess, which is today applicable on aerated beverages, pan masala, tobacco products, which, for example, or even automobiles for that matter. Today, when we buy a soft drink, aerated soft drink bottle, the GST rate that is 28% plus 12% compensation cess, so total 40% GST. Now what is this compensation cess? Compensation cess is basically a cess which was collected to compensate, so wherein the center had to give compensation to the states for the loss of tax revenue when GST was introduced. Okay, and it was always going to be a temporary provision for a few years. Earlier, it was for only 5 years. Okay. And in the COVID period, they took a decision to extend the compensation cess. Now it is till March 2026. Okay, so another 15 months or 14 months or so. But now the indications that are coming out is that the government may not further extend this compensation cess, which means the compensation to the state, the whatever they had committed, it is more or less the commitment is being met on a regular basis and they are on track. So if that compensation commitment goes away, then the government may discontinue with this compensation cess in future. But when they do that, okay, obviously they will try to increase the GST rate for those products. For example, those products where compensation cess was there. But at the same time, it will give them some buffer to reduce the GST rate for other products. Okay, so this is a great opportunity for companies to think and come up with specific case saying that for these products, please reduce the compensation, reduce the GST rate from 18% or 12%. Government is looking at all types of suggestions. So next 2-3 months, this is a great time to approach the authorities and go for this. Uh, Inverted duty refund. So today there are some sectors like the textile sector, or let's say the diaper industry. Those companies, the GST rate on output is lower than input, so they apply for inverted refund. However, the formula of inverted refund is a little complex, and we get GST refund only on the inputs. We do not get on input services. That's how the formula is worded. So another representation area is to ask for inverted duty refund also on input services, and not just on inputs, because today it is impacting those companies who are who are having this lower GST rate on output. Uh, the other representation areas are to allow input tax credit on civil construction, especially for the retail sector where there are so many stores. We keep, there are new stores being set up, renovation of old stores, okay, repairs happen. So this impacts, the GST becomes a cost. So the government needs to relook at least for the retail sector, they need to relook at whether GST credit can be given for this important activity. Uh, GST under reverse charge. Today we have to pay it through cash. But if we look at other countries, other jurisdictions, there are many countries where they allow GST under reverse charge to be paid through credit also. So companies have already having GST balance, ITC balance. They possibly have to pay GST under reverse charge still in cash, even if they have GST credit balance. But if we approach the government and say that we should be allowed to utilize the credit also to pay the GST under reverse charge, it may be a cash flow saving for many companies. Other couple of amendments are with respect to EV bill generation requirement. So the EV bill generation requirement should be dispensed with in cases where IRN is generated, or transfer of IGST, CGST balances between GST registrations under the same PAN. Yeah, so these were the amendments as far as uh, indirect taxes is concerned. We can just check if there are any questions, and we can quickly take those questions. I'll
I'll
just
just
okay. So I'll just read out some questions which are there, which have come on the chat. Uh, So first is, for which product GST rate could get reduced as a part of rate rationalization. So as I said, GST rate could get reduced for products. I mean, it depends on how we represent to the government. Possibly for some products such as food, processed foods, or such products which are essentials for the consumer, there is some case to approach the government and ask for reduction. But the industry and trade will have to go come ahead and ask for those requests and make a specific case out of it. Government is open to suggestions at this stage. So we will have to build a case, and we have to approach through industry associations like RAI and other associations also to basically represent before the government. The second is, when will IMS be made mandatory? The date has not yet been announced, but possibly it may happen in the next 2-3 months. There are some discussions going on 1st April also, but the date will be announced shortly. Third is, which products may get covered in the track and trace compliance. Under track and trace, possibly they have not yet notified the goods, but possibly products such as tobacco and pan masala, those kind of products may get covered. It certainly will not cover most of the goods. It may cover only specific goods. Fourth is, with amendment in the credit note section 34, will we need to give CA certificates for all types of credit notes? I think here the point is, we may not, yes, they have made this amendment in section 34, and there may be some pushback from the authorities saying CA certificates are required for all types of credit notes now, which will be a humongous effort. However, once IMS is implemented, possibly that can be a solution or an answer. Once IMS is implemented, possibly they may go do away with this CA certificate requirement, because automatically it will reflect on the portal. So then it will become redundant. So we'll have to wait and watch. So these were the questions posted on the chat box, and thank you everyone for uh, uh, sharing this feedback and questions with us. So with this, we conclude our today's session, and a big thank you to the Retailers Association of India, and all the uh, all the members, and everyone who have joined our today's session. Uh, Okay, we hope it was useful to you, and we look forward to more such interactions with you in future. With that, we sign off. Thank you very much. Take
Thank
care.
you, everyone. Bye bye.
Bye.